My name is Lutando Mvovo. I'm an attorney by profession, specializing in tax law. I'm currently working at Vodacom. My background is mostly on tax treaty policy. I worked for the South African National Treasury developing tax treaty policy for 10 years. And I left in 2018 to join the business side.
Hello, my name is Liselott Kana, and I'm the co-chair of the UN Tax Committee, and I'm a tax treaty negotiator, and I work for the Chilean tax revenue.
Greetings from India to everyone. I am Rajat Bansal, working in the Indian Revenue Service, presently as Principal Chief Commissioner of Income Tax at Delhi. I have been involved in the international taxation field for long, both in the policy and the implementation side. I was India's competent authority for tax treaty negotiations, mutual agreement procedure, advanced pricing agreements, and exchange of information for long. And I was also a member of the United Nations Tax Committee from 2017 to 2021. And I was closely involved in the two works of Article 12B as well as the indirect offshore transfers.
The concept of a permanent establishment is a difficult issue.
My understanding of the concept is that it's an international tax concept that is used to determine whether or not a non-resident taxpayer has presence or sufficient connection in another country, and therefore subject to tax on its income that is attributable to that non-resident in that country.
It was framed quite some time back to set a threshold for taxing the non-residents in the country where they go to do business and to which they do not belong. A physical place of business or an agent or some kind of nexus with that place.
The PE concept still relies on physical presence without taking into account that companies in our days would derive substantial profits from countries without really being physically present.
Due to new technology, it is possible for non-residents to engage at a very large scale in the economy of other country and do business there on a very large scale without fulfilling the requirement of permanent establishment, meaning thereby not having a fixed place of business, not having an agent. So it's no longer relevant.
I think that the concept is outdated. It originally meant for brick and mortar business, and then over time updated to reflect modern economy, but it's really not suitable anymore in its present form, of course. We might change that in the future, I hope.
Technical services are very important. In most cases, the definition will cover consultancy, management, and technical services. Within the definition of royalties, they would include fees for technical services.
Because of the difficulty of understanding the concept of PE, permanent establishment, because the way that countries interpreted the way that the PE services article was applied, it made things actually very unclear and the rules very muddy.
In a recent case in Kenya, it's Mackenzie, South Africa versus Kenyan Revenue Authority. The tax tribunal in Kenya found in favor of the taxpayer and said the correct interpretation of the UN, if you don't have an article dealing with these technical services in your tax treaty, you can only tax a non-resident, provided the non-resident has permanent establishment in your country.
So one of the things that we wanted to do was to make the rules clearer and avoiding base erosion.
The introduction of Article 12 Cap A in the UN, with its commentary from a tax certainty and from a consistency in terms of interpretation, to provide guidance.
Services rendered through internet in the other country with minimum human involvement. For example, online advertisement from the market jurisdiction, then digital content services, digital intermediation platforms, and online games, standardized online teaching.
Digital taxes or service taxes are taxes that are intended to tax non-resident digital companies that do not have presence in your country.
DSTs or digital service taxes came into being, and many countries started taxing the digital service revenue by levying a withholding tax on income streams arising from there to the non-resident, even when it did not have a permanent establishment. These taxes, since they are not part of the tax treaty, they were generally outside the tax treaty. Therefore, there could be double taxation.
We went for 12A because basically it was consolidating quite a lot of treaty provisions from developing countries. We wanted to have clear rules.
So first aim of the Article 12B insertion was to have a simple solution for the developing countries to administer. And the second aim was to have a fair and reasonable share of revenue or taxes out of this activity. 12B has two options. First is gross taxation. So a percentage of the gross revenue from automated digital services, due to the criticism that these taxes could be levied even in case of losses. The other option provided was net basis taxation on annual basis of qualified profits, which were defined in the article to be a portion of the profit from that stream of income or revenue arising from the market jurisdiction. A fair allocation was done to allow the source country to tax 30% of that at the domestic tax rate.
The bilateral approach by the UN, it came at the right time. It gives countries, especially developing countries, an option in their decision making, because we have a multilateral approach in the form of the OECD, Pillar 1, Pillar 2. We have the UN approach, which is a bilateral approach, and which, in my view, is easy to apply. And from a tax revenue perspective, it is easy to monitor.
Most developed countries already have the tax treaty network. So who are the ones who are signing now? Well, it's in fact more developing countries. In our treaty network, the latest treaties we have 12A. We have 12A with Uruguay, and we have a variant with Argentina. So in our neighborhood in South America, there is quite a good uptake. I think absolutely that if you ask business, they will be in favor with it.
From the point of view of the taxpayer. So if instead of paying taxes in country A, he may be paying taxes in country B, B meaning the country of source, A meaning the country of residence. So it's a matter of allocation of taxing rights between the two countries.
It is likely that most African countries will adopt Article 12B. It brings certainty and it will bring consistency in terms of application.
There has to be some sort of new way of looking at things because there are new ways of doing things. The UN has a role to play here. And I'm very happy we have taken the decision in the UN committee to work, for instance, on the concept of physical presence as a basis for an enterprise's activity.
If the scope of African countries' participation is expanded and they feel comfortable to contribute to the global developments, it will make things easy for tax authorities and easy for business operating in Africa.
The committee must go on working in the interest of developing countries. It's a very important role they have to play, and I hope that continues.